What's up, YouTube? It's Joe Catchpolia sitting on the couch, making some money investing in fractional real estate online, as usual. Today yeah, okay, sorry about that. Today we're gonna go over 9 Country Club Lane. This is a short-term rental in Westchester County, New York. It's gonna be managed by Earl, but as a co-host to this third-party property manager that does the short-term rentals, although I think he's going to do some of the bookings directly, it looks like. It's brought to the platform by this guy, Noah. Don't really have very much information on him. They say, okay, he has more than 15 years of experience in real estate and financial services. Whenever people clump stuff like that together, it makes me wonder. So I did click on the link to his LinkedIn page, which they give us. Um, Looks like he's been, running this company for 2 years and 9 months. Um, and I guess maybe has been doing it full time for, because if you look at his experience, it basically ended, um, shortly after this was started. But if you look at it, he was like in wealth, private wealth manager, but doesn't really have anything that screams like real estate experience. Maybe he's owned other properties. I'm not sure. He did share an article um, that I think said that he moved back in with his mom in 2020. Not that there's anything wrong with that. I just that the it makes me think he didn't own a bunch of properties at that point in time, right? Normally, if you have a lot of real estate, you don't end up in that situation. I'm really not 100% sure that that's what the article said. Hopefully, I'm not way off on that. He had posted it a while back in the Discord. I didn't go back and read it today, but for some reason, I think that that's what it said. But anyway, really not attacking someone for doing that. Um, at different points in time, I've moved in with family members or had family members move in with me, or had roommates, all different things, right? If you're a real estate entrepreneur, especially, there's just going to be times where maybe you house hack with roommates and all that stuff. So I really didn't mean that in a derogatory manner. I just mentioned it to point out that I don't necessarily think he's been owning investment properties for the last 15 years, right? Which is sort of what it sounds like when you say he's been more than 15 years in real estate and financial services, right? I mean, maybe, okay, 15 years as a real estate agent or something. I could see that too, but I think it's like he really has 15 years of experience in financial services and then has also done some real estate, is what it looks like to me. If that's not right, I mean, I think if you looked at my LinkedIn, you're not getting a full picture of what I'm doing either. I mean, maybe he's had investment properties all along and I just missed some of that. But anyway, I don't think that's incredibly important. The only reason I mention it is one of the things that I've talked about a lot is I'd like better deals brought to the platform. And I think part of the way that we do that is by attracting co-owners that are, experienced real estate investors who have these better deals and understand what a good deal is and what it's not, right? I think also too on this one, obviously his experience is bolstered by Earl's because we all know who he is. He's managing other properties on the platform, other properties in New York, other short-term rentals. So he's a known quantity. We know what we're getting. He's obviously been doing that. He's someone who I think we really understand what we're getting. I think if you've been in the Discord and own properties, own some of the Madison properties or some of the other ones that he's managed, which I do, so, I think obviously I think that gives him some, or gives this, some additional experience. It's going to be one of the things I think I talk about more. As much as I like to dig into the properties themselves, and we're going to certainly do that, we've really just seen like the co-owner that is bringing it to the platform has a lot of control of the direction, especially early on before they sell out a whole lot. And so I want to know who that person is, how much experience they have, what are they someone who we're going to be able to rely on to make good decisions? Are they, what are their finances like? Now, this is one where the DAO is going to pay the mortgage payments, which is fantastic. I want to see every DAO have their own mortgage payments in the DAO. I want to see them brought to the property that way, or to the platform that way, like this one is. Then we're getting a really true picture of how we're doing as far as cash flow. We're not sort of just moving money around and putting undue pressure on a co-owner. just to create some, false high yield that is very fragile. So anyway, glad to see that. So anyway, going to jump into some of the normal due diligence. Looked at the FEMA flood map. Was pretty happy with the way that looked. I was pretty surprised too because we are very close to the water, right? But I was perfectly happy with the right. Are we in? I want to say, you have this. Oh, where do we go? Ugh. Yeah, you really only have this thin flood zone, and so I'm assuming and I saw some pictures of it. It looks like there's a decent slope moving up to this property. So even though we're so close to the water, I was perfectly happy with what that looked like. This spot crime map is one of the best spot crime maps we've seen. We're going back months, and this is all that they came up with. I sort of expected that when you have these, the homes that are all spread out and they're big, expensive homes, you don't necessarily expect there to be a lot of reported crime. Um, at the same time, I have noticed that there are some areas that spot crime just doesn't pick up reports. I don't know why. Maybe it's just not able to. So if you're really concerned about this, it might be something that I would dig into more because whenever I see so few, it makes me worry like, oh, is it a reporting problem, right? But I mean, this sort of matched up with my intuition, so I didn't dig any further. You can see I'm going to try to go through some of this stuff quick. Hopefully, this isn't another hour-long due diligence video, but I've got some, I think, important math for us to really look at towards the end. And so, unless there's something like I really want to dig into, I'm going to go through this stuff quickly. Obviously, any of this stuff, happy to talk about in the Discord or in the comments. So, as always, please like and subscribe. And subscribe, please. I'm getting a ton of views relative to how many subscribers I have, so it'd be awesome if more of you guys actually clicked that little button. Um, YouTube always sends me messages about like I have views and not subscribers. What am I doing wrong? I don't know, but anyway, in the description of this video, I have links to all the places where I'm currently invested in fractional real estate online. Do your own due diligence on all those platforms and any of the properties that I talk about, including this one. And also, there's a link in the description to this video to that Discord that I just mentioned, where we talk about all different platforms, all different properties. You can jump in there if there's anything that comes up that you want to share about this one. I'd love to hear it because I'm going to go through a lot of this stuff pretty quick. Anyway, this is a very small town. I think it's around 7,500 people. Um, it looked like they lost a decent amount of population between 2019 and 2020. Thought this was a little bit odd. I mean, obviously we know what was going on in 2020, so maybe it had to do with how people were counted or something like that. Really not sure. Um, but this isn't even the way we normally see this presented, but it's because it's such a small population. I honestly really don't care about that number too much. I looked at the Westchester County, which is the county that it sits in. I think this is the more important info, right, as far as like looking at the trends. And it's a big enough county, right? We have a big enough population that I think this is data that can be trusted, which where you have the real small town, sometimes I can't. And you've had growth. It's not amazing growth, right? 5.8% over a 10-year period, but you have had growth here. Um, I'm perfectly happy with this because one of the things is this is not, you know, it's not a home where we're going to be looking for rentals, right? The actual population changes aren't so important as far as demand drivers for short-term rentals. Now, obviously, it does affect resale values in the future, right? You have that supply and demand, but you have really fixed supply in this area. The types of homes and the location, there's not a lot of like tons of new builds coming in to compete. So um, I don't know that level of growth in this type of market is something I'm perfectly happy with. Um, let's jump into the what the third party platforms say about the value. So this is being brought to the platform 1.948150, so $1.9 million. dollars. Uh, Redfin thinks that's a little high. They say about 1.575. One of the things when you have these types of properties, it's really hard, especially for some of the computer generated models to give you a good price or a good price for the home or a good estimate of value, because in an area like this, your views, the way you're situated, your construction quality is going to have a really big impact on the, it's not just a dollars per square foot in a neighborhood, and you can extrapolate it real well. So I don't necessarily always trust these. You can see, it was sold in August of 2020 for $1 million. So we've had quite a bit of appreciation in that short period of time, even to get to 1.5. But we're talking about twice that sale price. Um, Realtor actually thinks, Realtor, I guess, also thinks that that price is high, right? It thinks 1.668. Um, but then Zillow gives us a price that is a estimate that's over the appraised or the current value. And so this value is the appraised value plus 5%, just like almost always what we see on Lofty. Zillow thinks it's worth more than that, but one of the things that's really interesting, oh, I clicked on the wrong tab, is that this was listed for $2.1 million a few months ago for a very short period of time, listed for sale, removed at 2.1, right? If it was worth 2.2, someone probably snatches it up at 2.1. Even though this is a really short period of time, I think you still, uh, you still attract attention if you're $100,000 undervalue. So I don't know what Zillow's thinking, and you can even see, it shot up from during this time period. So I don't know what Zillow's doing there. It's pretty far off of the other ones. They all think that the price is a little bit high. I'm going to start closing some of these tabs because I have been having some speed problems with this. Hopefully I don't end up having to do this again. All right, let's see. And then the appraisal said, 1.85 million. Now, and then obviously, and I said this is, 5% higher than that. It's actually 5% higher than that, plus another like $5,600, something in that price range. Um, I don't know, maybe not exactly, somewhere around that. I don't know if they like added the value of some personal property or something. I'm not sure what happened there. We didn't have, there wasn't an explanation that I saw. Obviously, if that extra 5,000 bucks is going to kill the deal for you, ask about it in the Discord. Figure out, Earl is, he's going to answer all your questions quickly. I had, one about this today, and I got a response instantly. Um, he's just always in there, so that's one of the benefits. I looked through this appraisal. Um, Nothing real special. The comps are pretty old, but you've got stuff from December, which this is kind of far back, and you've got stuff even further back than that, right? The middle of the year last year. But because of the type of asset it is, it's a very small town, it's a big home. Um, to find comps for this property are going to be tough, and you're going to have to go back further in time than I'm usually comfortable doing. And so it really does. I mean, this type of home is really tough to price again, which is why I think you saw those models all over the place, right? So whether or not you feel good about this price, it's real tough, right? When you go to sell it, it's going to just really depend on what's your competition at the time, what's the demand in the area look like. I mean, as usual, but when you have a real limited supply and you have very unique assets, and I should, I mean, this is a home that is, it's not like, you know, you can imagine there's not hundreds of homes like this one to choose from, right? And so a lot of times these get priced. It is just really tough to price, right? And so 1.85, it's this I think is not too far out of the realm of possibility when you look at the Redfin and Zillow. It's higher, but it's not so much higher. But then when you add the extra 5%, that's when you're really starting to you're very close to $2 billion now. Um, but that's Lofty lets people do that to list on the platform. Most co-owners decide to do that, and and then some of them end up having to discount their tokens after the fact, and that might happen here. We'll have to see. Let's see. The inspection, there were a lot of little items. Um, this is something that they've been operating for a while. They've changed, they're changing managers. Earl mentioned somewhere in the Discord that they've had a lot of capex last year, because when we looked at the financials, it looks like there's still quite a few little issues. Um, it's a little worrisome, right? If this has been operating for a while. I mean, these stairs are crazy looking. I'm hoping there's a plan to replace these. I didn't see anything anywhere that indicated that there is, right? But I mean, obviously, they've got caution tape blocking this off. And you actually see some like newer wood. So I think I would just hope there is. But, really, one of the things I think every new listing should have is a section where they say, hey, this is how we addressed the property inspection items, right? Like that, we always get a property inspection, and then we don't know, like, well, did they just leave it like that, right? Is this just how it's going to be? Now, I know Earl's not going to leave this like this, right? I mean, but hopefully they already have quotes on it. Hopefully this was something they realized and were addressing beforehand. I mean, your deck just doesn't end up looking like that. It takes a little time to end up looking like that. So that worried me a little bit. Um, I'm not going to go through the whole thing in very much detail. You have some of this, right, where you've got I mean, this is that same section, but the stuff that I always worry about is water infiltration. You've got there's several spots where they have pictures of the gutters detached. Like, it's a cheap fix. It's something that's really just a little bit. Now they come up, if they come apart all the time, you have to come up with a solution to address that, right? But it's something that does happen. And at any given time, especially with a large property like this, there's going to be ongoing issues, and some stuff you're going to do right now, and some stuff you're going to do in the future. But the stuff that is the water infiltration is like the number one thing I care a lot about, right? Because it can impact all sorts of structural parts of your property. It can impact the way, have an impact on your foundation. It can, lead to termites or just rotten wood issues. Obviously, you should go through this in detail if you're going to buy into this one. They mentioned, showed some settlement. I mean, this was built in, I think, 1976. So you expect that most of the settlement that it's experienced, it probably, unless there's been some change in the way the water runoff is being handled, um, you'd expect it to not continue, not have some rapid new settlement, right? This has probably happened over a long period of time, but it is something that you really have to make sure that you're on top of. At one place, they mentioned that there are underground drains that they couldn't figure out where they terminated. So, like, okay, well, are they actually draining, or are they stuffed up somewhere and we can't see? I think that's an important thing to find out. And maybe the owner knows, maybe Earl's already aware of it, but whenever you see those things that they, are things that I want to know about. Looked like you had maybe a rotten wood issue here. Obviously, this is usually when you see these, usually this little part around here is decorative, but if you're getting rotten wood there, well, then the actual support in there might be starting to get that as well. Um, there weren't a ton of things in this that I wanted to mention, but there was one other spot I think that I wanted to show. Oh, and then there's just a lot of these little like doorknob missing type issues. And again, it is a big home. It's got a lot of doors. But if you're going to have guests in there on a regular basis, like those are the things that I just want to have immediately. Like the first time you figure that out, that's fixed the next day. I'm guessing when they got this home inspection, they like realized, hey, we've got all these things. Let's get a handyman out there and replace doorknobs, or I mean, there's a bunch of stuff that could be fixed with like a very low skill labor. Um, and that's the stuff that worries me, right? Like when you're running a short-term rental, you want to have a team that's able to do that. And I don't know how close, I should have looked how close this is to Earl's other properties. I know he's got people there that are like, he trusts to jump on stuff like that. So a lot of these things I think his team could handle. Maybe they already have handled. Um, but again, I'd love to see that in the description of the listing and saying, hey, these are the things that we saw, that you'll see in the inspection. We already addressed X, Y, Z. It seems like it'd be pretty simple to do that. And if they haven't, I'd like to know that too, right? Like, oh, well, we didn't really think this was a big deal, and this is why, right? Because sometimes that's true too. Like inspectors, it is their job to nitpick the home, and sometimes you'll look at it and think, oh, it's not that big a deal. Oh yeah, like they mentioned, like clean these gutters. Well, these aren't the worst gutters I've ever seen, right? Like, yes, of course, I want you to clean your gutters. How often you do it, he's got to mention it because there's stuff in there. Oh, but this was one that really bugged me, right? Like, um, so they mentioned that this is like I don't know if this is a putty or a tar that was used instead of a flashing that should be here. When you have fixes to your roof that are, And I mean, this is done just poorly too, right? It looks like I did this, right? Like I'm just not a super handy person. If you handed me some tar or some putty or whatever this was and told me, hey, go patch that, this is probably what it would look like. Whenever you don't have like the approved flashing, when you have roof penetrations, that always worries me. Like the roof is a place I never want to skimp on, right? Again, because you get water infiltration. Um, I didn't notice how old he said the roof was. And so that would be a question that I'd have as far as like, one of the things I'm going to talk a little bit about is reserves for this property because I think it's a bigger deal when you do have the debt inside the structure and when you just have such a big home like this too, right? I mean, this is a property that you can't skimp on reserves. So I'm going to talk about that a little bit. And one of the things that would go into that thought process is like, okay, when are we replacing this roof, right? Um, that was the only other thing because there's a couple of spots where there's just uh, the roof doesn't look great. It doesn't look super old, but I didn't notice the age. I think there wasn't anything else that I wanted to mention in this one, um, except that yeah. See, you've got a couple more spots, or this is the same spot I think in two different pictures. Uh, but this one was a different one. This might be the one we saw in the picture before. I just think anytime you have this it is a very simple fix, and I mean, probably you need one more piece, right? Like probably they're trying to stretch this gap, and that's why they're falling off. But it's a very simple fix. It's one that if you do it right, it shouldn't keep coming apart, and it makes a big difference for your property. So I know you guys probably get sick of hearing me talk about gutters. I think it's a big deal. And then, oh, there was a couple places where they mentioned that they have like roof discoloration, which a lot of times does mean that you're getting moisture trapped underneath here. And so if that's the case, you want to find that out. That's really all. Obviously you want to dig through this whole thing though before you pull the trigger on it. But those were the big things. So, okay. The finances, they gave us a couple of things. Earl had mentioned like, hey, really don't look at the 2024 numbers to extrapolate those wouldn't make sense. And that's good because it looks like they lost money in 2024. Right? Net operating income, cash flow, rental yield. Yeah, I mean, it looks like that was a negative number. But he said really what happened is they spent a lot of money on CapEx. And just put that stuff in here. Well, it's not great. I'd love to see this the 2024 with the things that are truly capital expenditures pulled out so we could see what that is. We can see, the total revenue number, which is 120. Again, they're changing managers and expect to do better than this. So that's great. We didn't get full projections from them. Earl was like, I really don't want to give you projections. I understand that. I mean, I think um, he doesn't want to take on the liability of telling you what it would do, but he did share the Price Labs, estimate of annual revenue. This is one of the numbers that I like to look at all the time. I actually pulled up AirDNA, which says 127 for the same property. Again, whenever like AirDNA has a very hard time in areas like this, just like for the same reason that pricing does. Like, it doesn't know who's got a nice view and who doesn't. It doesn't know like how the lot's situated. Like if it just seems like real picturesque or if it's, like these. I'm sure. Well, I don't know. I mean, maybe these are probably not great comps, and so and there's obviously not a ton of them either, right? Not a ton of the similar size properties. So, okay, 127, Price Lab says 145.7. I'm going to use this number when I use calculations. They even give you like, okay, maybe up to 226,800. Um, but I want to look at that, right? But before that, I want to talk a little bit about the loan amount or the loan. Okay, so it's an interest-only loan. It's currently at 2.875 interest rate, and it stays that way until December of 2031, at which time it is going to adjust to, I believe, 3% over the index. Is that what I saw? Um, yeah, 3% over the index. The index that they're using, I think, I believe it's this SFOR averages 30-day. When I was looking at the loan doc, this is what it appears to indicate. So, like, if it adjusted today, the rate we'd be paying is, 4.34 plus the 3%, so about 7%, right? Which means that your payment would double. Okay, well let's look at a couple things, right? Um, and this is Lofty's fault. This is not Earl's or the co-owners. This financials tab is terrible, right? We've got $52,000 in utilities. This number is actually just everything that's not property taxes, insurance, property management. It's everything else stuck in there, which I believe is also including the loan payment because this cash flow it becomes the what's getting paid out and paid out as yield. So right now we've got okay $62,000 in positive cash flow. Well, so let's say, okay, you've got about another 4% on top of, is that right? Yeah, a little bit more than 4% additional interest once the interest adjusts, right? So if we have $1.2 million times 0.04 divided by 12, or nope, just multiply that by 12. Okay, so once that adjusts, if everything else stays the same, oh, close that. Okay, let's see. If everything else stays the same, you're going to have $48,000 more in interest payments, roughly, right? It's actually going to be a little bit more than that. Let's just call it 50. And so instead of having $62,000 in projected annual cash flow, you'll have 12, right? Um, it would be a huge decrease, and so that would bring your yield down to like what is that? Well, let's see, 12,000. Um, let's see, what are we doing here? 15,213 times 50 divided by 12,000. And we're going to 1 over x that. So you're going to have about 1.6% yield if that rate adjusts to current rates and income and expenses have remained flat that time. Now, I think that like so obviously if you bought this property using a mortgage at today's rates, and it would probably be a little bit lower if you use today's rates. Um, so maybe there's some opportunity to refinance. Maybe it's really not even that much lower though, especially because this is an interest only loan. This would be terrible revenue based on the numbers provided, right? I mean, you'd have a extremely tiny rental yield in that scenario, right? If so, most of what's working for this property is, assuming that these numbers just keep up, and this has a $214,000 in gross rents, which is not what we have as our price labs number. So I mean, this is why I hate Lofty's tab, right? Because all they're doing, this just comes from annualizing this most recent month, right? And that's what's happening here. Well, if you look at this month, it's one of the best months that they've had, or it is the best month that they've had here. Let's look at last year. Do we have a better month than that last year? Well, in last year we do just have all the. Okay, we had last January was the only one that was better. Um, or was I looking not comparing apples to apples there? No, that was true. So I don't know. This is obviously annualizing, the best recent month. Um, and so I think if you look at it with that 1 point, or using this revenue, you're just going to be, you're not even going to be at this number, right? And I think it's important to realize because like people keep doing this, they're bringing the short-term rentals to the platform, trying to have after a perfect month or sometimes giving a rent. I'm glad they're not doing a rent credit to match some month, right? I mean, that's even worse. Now, hopefully, because they've changed managers, because they've done some capex, hopefully they're on the rise. But if these numbers are annualizing a gross rent that is not what he provided for projections, although it's close to the top end of this. So this yield may already be inflated, and I believe that it probably is because again, I think this is just annualizing a pretty good month. But in addition to that, we're only really getting it because we have this below market loan. Now that's an asset for us, right? I mean, it's not truly an asset. Loans are liabilities, but the fact that we have this low interest rate is a benefit. And so it is a reason to maybe invest in this deal. If the deal was kind of, if it was a borderline deal financially, but you had, but it worked this way, but you have that low interest rate loan. I could see wanting to buy it because you're getting some savings for the next 5 years, and then you have to figure out what you're going to do, right? Hopefully, you get to refinance before then. Possibly you sell it. Again, I'm just going to close a couple tabs so we don't have too many things going on. The only other thing I looked in what the management fees are, and it's Earl has got 20% in here, or it's actually this Earl, or is this? Yeah, Earl has got 20% in here, but he's acting as the co-owner, as a co-host for another third-party manager. So I'm curious how that works. Is it like they're charging a management fee and then on top of that he is? Um, I'll admit I just didn't read it very carefully. Maybe there's an answer to that here. If you know the answer, feel free to give me that in the comments. Or if you don't and you're thinking about investing in this one, definitely ask Earl about it. Again, I wanted to kind of go through a lot of this stuff kind of quickly because I want to just show you, okay, whenever we're looking at deals, and this is why I'm always comparing everything to Mogul. Um, Again, I've got links in there in the description to this video if you want to join the club I'm in on there, or if you just want to get, they give you some money if you sign up. But again, do your due diligence on that platform too, because they might not turn out as great as they seem so far. But whenever we're investing in real estate or making any investment, we always have to compare it to other options, right? And, and at the moment, the most obvious other options are the short-term rentals that Mogul's putting out, right? If I'm a fractional real estate investor and I'm just looking for something where I can buy a piece of an investment property online, their deals I think are the most similar to something like this that I can buy on Lofty. Now there's a lot of reasons to pick one platform over the other. For me, I think the deal, the property that we're investing in, is the most important thing. And then, okay, if there's some nuance to the platforms, maybe that's a reason to pay a little more for one or a little less for one, depending on the platform itself. Um, but so what I did is I took all the short-term rentals that Mogul's put out since I started reviewing them. This is the first one I bought a piece of, the Axelrod. But all of these have been put out since December of last year. So all these came out this year. The check marks indicate that it's one that I invested in. Um, and so one of the easiest ways to compare across properties, sort of, quick rule of thumb type comparison, is to look at the revenue to price ratio. And, I've mentioned a lot of times, well, when I'm looking here in San Antonio, I'm always trying to get close to a 20% revenue to price ratio. I think it's not really fair because that's not, we're buying a vacant home and then you've got to put furniture in it and you don't have any history of revenue or anything. And so that's the reason we're shooting for such a high number. And even though that's what we shoot for, sometimes we'll get ones that are like 18. I mean, it depends a lot on the client and what we're doing. But I thought, I always mention that when I'm talking about revenue to price ratios, but I thought, why not actually show you the ones that are something else that you can just buy a piece of right now? And some of these are gone and you can't, but some of them are still available. And so when I just look at revenue to price ratios on every single one, you can see, they average 14.47. And for mine, the ones that I picked, a little bit higher, 14.86. Um, I think if you think about, the reason my average is a little higher is because obviously I'm trying to pick ones that have better revenue to price ratios, but also to the ones that I didn't pick, there were other issues that I just thought that kept me from doing it. So I honestly, 14.47, if you look at that average, it's probably a reasonable number, at least in my mind. Obviously it's a top line number, and then you need to dig into a little bit more details. But when I look at this for Nine Country Club, and what I'm using is the price slabs number from that Earl shared, which is the high. It's higher than the Air DNA prediction. It is higher than last year's top line revenue, and so we're kind of already stretching by taking that number. Now, Price Labs did give a range, and they had ones going all the way up to 220, 226, I think. And so, but I think that, I never am going to pick numbers, pick the top of a range when I'm looking at projections, unless there's some reason where I think my home is just so much better than everything else. Maybe I'll start to work with it, but it's certainly not conservative. When we're looking at the ones, the projected revenues that Mogul's using, in almost every case, they're taking what the property actually did last year, and in most cases, it's either that number or a little bit less than that number. Some of them, they made some adjustments because the owner used the property a little bit last year and whatnot. But a lot of them actually, their projection is lower than what AirDNA gave me, or lower than when I dug into comps, what I really thought it should be. So I think they're using a pretty conservative number. And so to use apples to apples, maybe we shouldn't have even used the Price Labs number, but um, even with that number, and then the price that we're paying for it, which is, I'm not using the full capitalization amount. I'm using the price of the asset, that number. Um, and you can see the revenue to price ratios, it's just over half of what I'm averaging on this other platform. So it's really hard for me to want to buy into a deal when I'm comparing it. But now, again, this is not an apples to apples comparison, right? Nine Country Club has an existing mortgage that has a rate that's less than half of the rate that we're getting on any of the properties that we're currently buying on Mogul. And so that would imply that we're going to be able to get a lower, we're going to be able to get more cash flow out of a lower revenue to price ratio. If we were looking at a 10 or 12, percent revenue to price ratio, and then we started to throw in, okay, we're getting this savings, I think that would make a ton of sense. But when we're looking at a number that's so much lower, I think it's problematic, especially because that rate's only locked in for 5 years, and that might seem like a long time to people who are, day trading and looking at, daily rents and whatnot. But it's really not a long time when you think about a real estate asset, especially because part of this investment is we have to sell it at some point, right? If rates go, either we have to refinance in the future and then live with whatever those rates are, or we're going to end up selling it to somebody who has to live with whatever the existing rates are at that time, right? And so in that scenario, we might get much less, what that might turn into is just getting a much lower sale price. Because, I mean, again, remember, this is a 5% inflated price, and there's actually 5% plus a little bit inflated over the current appraisal. That appraisal is, a little bit higher than some of the third party websites. I mean, this price is almost double what the property was purchased for 5 years ago. And there has been that much appreciation in some markets, but it's certainly um, having a 5 year period to be like, okay, between now and then, we can figure, we have something, we either have to refinance or whatnot. It's not a long enough period of time to make that deal just so much better that I'm willing to look at something that's a half the revenue to price ratio. Now, the other thing that affects this a little bit is, the property tax rate in one market versus another, the insurance cost. There's all these other things. So you can start to dig into the numbers a little deeper, and there could be some nuance. So, but what I've found over time is that that might mean one market you can have 14, the next market maybe 12 is better, the next market maybe 17. I've never, below 10% is just such a low number. And part of the reason is short-term rental business is very volatile, right? Like I want to have enough leeway in there that I can have a significant drop and still cover my mortgage and still, those are all things that I'm considering. And so it's not as if like it's just a rental rate and where rents very rarely go down, long-term rents. Short-term rental outcomes change drastically, whether it's the rental rate, whether it's the occupancy, you have a bad summer and you lose a ton of money. And so that makes this for me a very difficult buy at this 7.48 revenue to price ratio. Again, about half of what my average is when I'm buying stuff on Mogul. Um, Also, and sorry if this is getting choppy, I've been having to pause the screen recorder quite a bit because it keeps hanging up. And so I've recorded this part quite a few times, so hopefully I don't have to keep doing this. But I gotta figure out what's going on. I think it's actually a laptop or internet connection issue, not really. It doesn't really seem like it's the screen recorder when I have tried to troubleshoot it. But anyway, sorry, you always hear about that. You don't need to. Um, in addition to having that low, rent revenue to price ratio, the other thing is when I'm looking at like what does Mogul do as far as reserves? They're raising these huge reserves. Like if you look at my numbers, they're going to be different from what Mogul presented on their website because Mogul is clumping reserves plus closing costs together. I backed out what I think is a reasonable number for closing costs. Obviously, this one is a little bit weird. There must be some additional work or something they're planning to do with the property because it's so much different than the others. Like if you look at it, it looks like on average they're reserving around 12% of the purchase price, in a reserve for not just operating reserves, but because you have debt service, right? And on Lofty, we already struggle to maintain proper reserves, right? And that's with properties that don't have to pay their own debt service. Once we have debt service inside the DAO, I 100% believe we need a debt service reserve. I'd love to see it be a full year of payments, especially on a short-term rental, but at least 6 months, right? And so on a property like this, if we were going to, so I think a way you could look at it is okay, 5% operating reserve, 5% debt service reserve gets you to 10%. So that would mean we're, have, and I mean, if you do the 12% that Mogul's doing or somewhere around there, we're getting, $235,000 in reserves. I honestly think, I've talked about a lot of times, I think they're being pretty conservative with the way they do reserves and insurance and a whole bunch of things. It's part of why I like them, right? Because you're still getting good returns with some pretty conservative business practices. But at least that's the impression that I got so far, right? I've only been investing with them since December. But again, I'm just always trying to compare what's my options, right? If I want to buy a short-term rental, and this is what I'm presented with on Lofty, and those are the deals I have over there. I just have to compare them, right? And so, what are we reasonably going to have as a reserve for this property? Well, with the co-ownership properties, we don't have to have any specific reserve, right? They set it at zero in there. Um, as they sell out equity, they'll collect 2.5%. If they sell out all the equity, that doesn't even get us to $20,000 in operating reserves. They're obviously not going to sell it all out. And over time there'll be some trading and so that'll add to it a little bit, but you're just paying for that when you're buying it, right? Um, do you think, given all the activity we've seen around reserves on Lofty, that there's any chance we'd ever in this DAO hold $200,000, right? Which would be, um, you know, so, a similar level of conservatism of what they're doing? I think the answer is no, right? I think if we get past $50,000, you're going to have people screaming to, hey, let's pay that out, let's juice our returns, let's buy crypto with it, let's invest in another DAO, let's put it in Earl DAO. You'll have all these other things that people are going to want to do with those funds versus really just having a reserve fund there. Now, I know Earl, being a co-owner in this and also being the creator of Earl DAO, is probably just going to say, well, yeah, we put it in Earl DAO, and then, that's just the shared reserve basically across all the DAOs. And if that had been operating for several years already and it was working perfectly, I would jump. I love that, right? But to have that be the answer in a scenario where we're some of the first actual cash going into it. I know there's some cash, but it's not, it isn't working yet the way he's hoping that it will, and I hope it works out that way too. But it's not where I'd want to put funds right away, especially if we did raise what I think is a reasonable reserve for a property like this. I mean, like, let's say you even just have, okay, $50,000 capex reserve, which is not a ton of money for a $2 million property, and then a year of interest payments, and so that's, we got $80,000, right? I don't think there's any chance we're ever putting, like, as with other Lofty investors, they're ever going to put aside that much cash without just starting to play some games with it, right? But I think if we did that as part of buying this property, one, it's gonna dampen your returns in the first year. Um, and it is these reserves, the yields that you get on Lofty or on Mogul are already taking into account the massive reserve that they raise when they make their purchases, right? And so I just want to make sure that's clear when we're comparing the two. So it's really tough, right, to be like, okay, let's say we just have 80,000. I just don't picture the co-owners, the other investors in this property with us, even being okay with that. And so I just start to get worried, right? Like it's a very big property. You say, well, what could you possibly need $50,000 for, right? If there ends up being some problem that affects the foundation, now it's sat here for a very long time, so usually you'd expect that there wouldn't be one. But that sort of stuff sometimes just suddenly comes up, right? Suddenly you have some sinkhole, you had a storm and the water ran off in a weird way, and oh, okay, well, okay, if you have that, and then it also as part of it, a part of the repair, you broke, the plumbing issues come up, or you have to replace windows because they've cracked as you've leveled the property. All those, it can, and some of that stuff maybe you get covered by insurance, but a lot of it you don't, in my experience. I have heard a lot of people talk a lot about, oh, well, just we're just going to get more insurance for things like this, and there's all sorts of things that can happen to your property that your property insurance is just not going to cover. And so, it's important to understand what those things are and what they're not. And it depends on like how rapidly something happened, and or if it was something that happened over time and we just didn't catch it. And, there's all these different reasons. But yeah, anyway, if I had a property, if I own this myself, just straight up, and I was going to have, okay, what do I think is a reasonable reserve on it? Yeah, for this home, I probably would want $50,000 plus a debt service reserve. And sometimes I don't necessarily care for the debt service reserve if I know, okay, well, I have significant outside capital that I could just continue to carry it, from my income. That's another story. But when you have it, you're creating this entity where you're trying not to have capital calls. You really can't count on them because of the way our co-owners are. I do just want to have, uh, and that's the reason you see these big ones in Mogul, right? Because they have all individual entities. They're trying to set it up in a way that they're just never going to have to do a capital call. Now, could something go so wrong that they have to? Of course. But I'd much rather have it be this way, um, especially when they're still able to provide a good cash on cash return, even accounting for that, than I would like having these like really low reserves, or where we start to play some games with them once we do start to develop them, right? And again, on here, this rental yield is assuming that all your, the only, it's really just based on the $50, so it doesn't even take into account the very small reserve that you put in, the 2.5%. I think that's, hopefully I haven't said reserve too many times that now the word has become meaningless. I sort of feel that way. But yeah, both on from a revenue to price ratio standpoint, from a reserve standpoint, it's, I, it's hard to make and I guess we could do it, right? Like if all the co-owners wanted to, you could raise that huge reserve as part of this. But then again, your returns are going to come down even lower. So the big thing that this property has going for it is it has that really low rate. I just don't think it's enough. Well, I can tell it, it's not enough to make the cash flow actually work, right? Actually beat those competing properties, because you're only getting that 8.33 annualized return on months where your annualized gross revenue is 214,000. Well, that's not what we're projecting, right? We're at 140. So we're at significantly lower than this. Um, Anyway, Earl, hopefully you've watched this, and we can still be friends. And you can tell me all the places where I'm wrong about assumptions that I've made. Maybe and that's the thing. Like I do these, and I really appreciate when the co-owners, and I guess Noah as well too, right? If I've said stuff, hopefully the stuff I said in the beginning I really didn't mean it in an offensive way, but I really hope that co-owners watch these and actually address a lot of the stuff that comes up, or that people that are interested in investing in these deals ask those questions in the Discord. I mean, that's what we've seen happen a little bit. Um, I'm sure there's other stuff that hasn't been clear. A big part of it is Lofty just doesn't make it easy for you guys to, I mean, this, I already talked about this, right? That this utilities number is just everything that is not one of these. Like Lofty just doesn't make it easy for you to present the whole picture here. And so then you're stuck with, okay, you're going to give me Excel files, and then like I understand being hesitant to actually create some projections that aren't based off of last year and also aren't just creating some future number. I feel the same way when I'm helping clients, right? I always like give them third party, okay, well, this is what AirDNA is doing. These are actual comps that we have that we can point to. But I'm never going to put together a projection for somebody because I think you're taking on that risk, and that's it, it is really our job as investors. But to a certain extent, I'd like some better, I wish it could be presented better than it is, and I know, I know that it's hard, right? They're just not really giving you a lot to work with to be able to do it that way. But a couple of things. So just to wrap up, right? Uh, I'd really love to know about, okay, from the inspection items that came up, which ones are already addressed and which ones are planned to be addressed? And, do we have, like, is that deck, right? Are there quotes for replacing or repairing that? I mean, not replacing entirely, but for repairing it, replacing the railings, all that stuff. That's I think the biggest one, right? And what's that going to cost? It's probably not a ton of money, but it is, it's enough that it's worth thinking about in terms of like this is, I would just love to see how those are addressed. What do you think about like is there going to be a larger reserve on this property than on other properties because it does have the Dow paying for the debt? I think that's something that we really should think about. Um, if that's going to be raised as part of the initial raise, well, then that has to be taken into account when we think about the yield. And then I am curious, I know you gave the Price Labs number. Yeah, I'm just talking right to Earl now, I guess. But we have that Price Labs number. Like, is there, Earl or Noah or anybody who's buying into this? Do you think that number's low, right? Do you think you can get to the 226? Or some other number like in that neighborhood. And if you do, I mean, I think I looked at it and that gets you to, an 11 or maybe somewhere around 11% revenue to price ratio. And then maybe if you somehow can convince me we have lower expenses and whatnot, okay, now we're getting pretty close to a comparable deal, especially because you've got the lower interest rate for the next 5 years. Um, I don't know. I'm curious about all that stuff. Hopefully, as always, the goal is one to create a conversation about all this stuff so that we can dig into it, figure out what makes sense. Maybe the answer is, yeah, this deal makes sense, but not at a 5% premium to the appraised value, which is a pretty high, number relative to the income that it's able to throw off. All those sorts of discussions. Um, but again, not my decision, but I'm just trying to open that up to like if we have to think about, well, where else can we put our money? I just want to be able to make that comparison. And I think it's I don't think I've made it like directly often enough, but it's something that every single time when I'm investing anywhere, I always think about, well, where are the other places I could put this money, and get a similar risk adjusted return. And I know for some of you guys, you think the best risk adjusted return is coming from Bitcoin. And I'm not going to argue with you about that because there's none of us actually know, what the future is. But if you think that's where it is, okay, go buy some of that, right? But it is once we start to make more apples to apples comparisons of okay, this property that the more we can sort of normalize it and say, is this a similar level of risk? um, which I think, okay, we're looking at STRs. They are completely different markets, but I think it's sort of the best comparison that I could come up with today. I think when I've compared it to the ones that we sell here in town, I think it's not the best because those are typically not already operating. The furniture's not already in place, so you have to adjust for all that. So I'd rather. That's why I decided, hey, let's just look at the other ones that are much more similar deal, right? Anyway, that is it for me for today. Um, Hopefully we can all be friends. Until next time, still be friends, right? Like not like hopefully I didn't ruin things here. I'm always, especially the people that are pretty active in Discord, but really everybody. Like I don't want to offend anybody when I do these. I'm trying to be as fair as possible. Hopefully that comes across. Even on some of the ones that I think are absolutely horrible investments, um, I still try to, be a little bit tempered. I don't know that I've ever actually said like, this one's horrible, don't buy it. Because one, I'm not trying to give people advice like that, right? But anyway, sorry, way, way too much rambling. Until next time, gonna keep making mistakes so that you don't have to.